Hi, everybody, and welcome to video number 6, our last video in chapter 7. And here we're going to look at an example of when ending inventory is misstated. So here, to illustrate the effect of net income over a 2-year period, GameStart understates its ending inventory by $10,000 in 2024. Everything else is correct. So if I look at that for a second and I take beginning inventory plus my purchases and I subtract too low a number for my ending inventory, that means my cost of goods sold is overstated. If my cost of goods sold is overstated, that means that the effect of that error is to decrease net income, which will in turn decrease retained earnings. But then that ending inventory that was on the low side in the next year becomes the next year's beginning inventory. So then that error goes the opposite way. I understate cost of goods sold and I overstate net income and I overstate retained earnings when it comes over to the balance sheet. So let's look at this one. GameStart understates its ending inventory in 2024. All the other items are correctly stated. The effect of the error is to decrease income in 2024, increase net income in 2025. The error is counterbalanced, offset in 2025 because the beginning inventory is understated and net income is overstated. So if you think that through with that little formula that I just articulated, I think you'll be able to see how these impacts affect the different pieces of the equation. Okay, so the following illustration shows that the income statement misstates total income for both figures in 2024 and 25, although the total for the 2 years is correct. And there's a big assumption there that that tax is the same percentage. It sometimes is not. All right, so here we go. And they did not include taxes in these expenses, it would appear. So here we go, our revenues here, and here is the understatement of those ending inventory. It should have been 30,000. It was 20,000, so it was understated. Cost of goods sold, therefore, was overstated. Gross profit was understated, right? So net income is going to be understated too. Now then, this ending inventory ripples up here, incorrectly, of course, and it goes down the same channel here. And for the 2 years, the total is $30,000. If we did it correctly, you can see the 30,000 in ending inventory and beginning inventory. We're going to have total income of 30,000 over those 2 years. Okay. So if it doesn't record as a purchase certain goods that it owns and does not count them in ending inventory, we're going to understate that inventory. Let's take a look at the retained earnings here for that, and we don't count them in ending inventory. So ending inventory is understated here. So from the standpoint of the balance sheet here, it doesn't affect the cost of goods sold and net income because these errors offset one another, right? Here, we did not record a purchase that it owned. It didn't count them in ending inventory. We put them over here. All right. I think you all see that. Now, the effects of purchases and ending inventory errors. So let's assume that GameStart understated accounts payable and its ending inventory by 40 grand. So in that case, its current liabilities should have been it should have been 80,000, I guess, but it was 40,000. So our current assets are understated by 40,000 and current liabilities are understated by 40,000. And here, if we do it correctly, current assets would be 160,000 and current liabilities would be 80,000. So the current ratio would be dramatically impacted by those errors. Okay, so here we're going to illustrate a few things. Here's Leslie Fay. They had accounting irregularities that wiped out 1 year's net income and caused a restatement of prior year's earnings. That's never a good thing when you have prior period adjustments like that. It inflated its inventory and deflated the cost of goods sold. Here, Acctg Brothers had to restate its income by 1.7 million because an accountant in the antenna manufacturing division overstated the ending inventory, and that reduced the cost of goods sold. Of course, it made the profits look better for that particular year, and then probably manipulated by the accountant here in this case. AM International allegedly records as sold products that were only being rented. As a result, inaccurate inventory and sales figures that inappropriately added 7.9 million to pre-tax income. Okay. All right, that ends chapter 7. And when we return, we will move into chapter 8. Until that time, bye for now.